Gold is down, oil is down. Good morning, I'm Joe Doe reporting from the NYMEX. Oil prices are slightly lower on Tuesday as a number of traders continue to contemplate a stockpile in crude oil. We'll see the EIA report coming out tomorrow, but we also have nuclear program talks with Iran that are coming up next week. Inside our studio at Wall Street is Dan Dicker to talk about that issue. Dan, how you doing?
Okay, Joe. Nice to see you.
Dan, when we look at the Iran issue, how is this affecting the global oil markets?
No, it's a big deal, Joe. I mean, there's been a pressure put on the oil markets recently because of these talks with Iran, but they did come to nothing over the weekend. But the expectation, I believe, is still that some agreement will be reached next week or the week after in Geneva, and therefore the pressure on oil remains. Now, that's really a Brent issue we're talking about. So the lower prices we're seeing today in WTI are more what you're talking about, which are the upcoming reports that will be out on Wednesday. But the Brent price is actually showing a little more strength today, and that's because of the failed, or at least temporarily failed, talks in Geneva between all seven powers and Iran. One of the interesting things about the talks is that there has been some pushback from not only some members in Congress, but also from the French. And that's been an interesting kind of change of events. And it's the Iranians who, in fact, have said no to most of the compromises that have been put on the table in Geneva. So we'll have to see what goes forth from this. But Kerry, the Secretary of State, is still sounds pretty optimistic that they will find an agreement here somewhere.
All right. Well, Dan Dicker, as always, thanks so much.
Right.
Earlier, I spoke to Tom Karsten of Karsten Advisors about land leases and the effects that it's having on oil stockpiles.
The number of leases and the tremendous amount of leasing activity that we've seen over the past 3 to 5 years is putting a little bit of pressure on the market in terms of pressure on the producers to finalize those leases. They risk losing the leases if they were to let those go. And so we're seeing a lot of activity not only in the drilling, but activity where leases are being sold to other producers in projects that might not be viable at the current price, but because they're able to acquire the leases at such a low price, they are viable at today's prices.
And these drillers are trying to get as much up out of the ground before those leases expire.
That's correct. And a key component of retaining the lease is that there is drilling activity on the property. So that's why it's important for them to at least begin the drilling activity, and then as long as they are producing, they retain their rights in those leases.
So Tom, this makes me wonder, with the shale revolution, the amount of oil that we are pulling out of the ground here in the United States,
Sure.
Is there a point at which we're going to say it's time for a U.S.-based OPEC?
Well, it begs a question of trying to maintain price stability, which was one of the goals of OPEC in their heyday, was to try and control production to a degree where they could create a more stable price of oil. And I think that's something that would certainly be beneficial to North American producers. You've got a lot of projects like the oil sands in Canada and a lot of the shale projects in the United States that require a higher price of oil, let's say north of $60 a barrel, that will require them to be viable economically. So there's certainly a lot of interest there on the production. Now, we have a lot more legal requirements here in the U.S., so there's a question of how that might come to play, but there certainly would be the desire, I think, there from North American producers.
Yeah, it'll be interesting to see if that does happen, government-led or private sector-led, we'll see. But Tom, thanks so much.
You bet. Thanks for having me.
Gold prices are slightly lower as traders continue to look at a very quiet period for the yellow metal. Here to talk to me about that today is Paul Sachs of Aurum Options Strategies. Paul, great to be with you as always.
Thanks for having me, Joe.
So Paul, we have Janet Yellen coming up to the Senate Banking Committee later this week. What happens in a scenario where for some reason Janet Yellen does not receive the nomination from the Senate?
Okay, so I guess most market participants would think that would be unlikely, but should it happen, I think it would be less a function of Yellen's policies per se and more a function of just general dysfunction in Washington. That could be bearish for the dollar and constructive for gold in terms of leading to a bit of a safe haven bid. But I would follow that up by saying this year we've had several safe haven potential situations for gold. Cyprus, Syria, shutdown. Gold has delivered very little for you this year in terms of safe haven.
And turning back to the yellow metals price movement lately, it's been very quiet, tight range. Do you think traders should just stay on the sidelines?
Yeah, it certainly does have that feeling that the year is more or less done. It's very, liquidity is low, volume is low, it's quite dangerous. But the options market is telling me really it's in a bear market. Volatility for the puts is higher than for the calls. Puts are in demand. And I really think, like it's very tempting to try and pick a high in the stock market, it's very tempting to try and pick a low in this gold market, but that's very dangerous. I think we're headed lower. I think if you're a long-term investor, you can buy very small, but if you're a short-term trader, really you're playing a very dangerous daily game about data points and whether it may alter when QE is coming and so on.
Well, it's obviously been a tough year for the yellow metal. That is Paul Sachs. I am Joe Doe reporting from the NYMEX. Take care.